These may be the scariest words an investor can hear. It's different this time. But BKD portfolio manager Jeff Layman says that even though there's a lot of uncertainty in the markets, there are plenty of differences between now and the worst of the financial crisis. Jeff is joining us from our New York studio this morning. Jeff, welcome to InBusiness. You often see the comparisons between '08 and what's happening now. One thing that seems to be higher, correlations. How are you surviving in this market?
Well, correlations do tend to come together in times of crisis. I would argue, though, that in this environment, diversification's working much better than it did in '08 and '09. You don't have asset classes like investment-grade municipals or investment-grade corporate bonds selling off in conjunction with other parts of the market, although there has been this significant sort of risk-off trade, which has pushed down values of stocks and certain other asset classes around the world. But, you know, in our view, earnings are in much better shape than they were in '08 and '09. And the best thing about that is that that's without a lot of help from financials, because they contributed a lot to the earnings in '07, but not so much today. So overall earnings are near peaks and are much healthier.
And yet, you just mentioned the financials. You do like JPMorgan. Why is that different for you?
Well, you know, when we look at the universe of particularly large cap U.S. stocks, we see across sectors opportunities to buy great companies at valuations, in some cases below 10 times earnings. JPMorgan would be one there. Yields above 3%. And with dividend payout ratios that are very low. In JPMorgan's case, the dividend payout ratio is less than 25%. And chances are that that's going to rise going forward. We think it's in better shape than most of the big U.S. banks.
And you do like an economically sensitive stock here. You like some of the energy companies.
Well, you know, energy, obviously these stocks have sold off a great deal along with the price of the commodity over the last few months. And here again, one of the things that we're trying to do in our portfolios is to diversify also in terms of income sources. So to the extent that we can get a company like ConocoPhillips with a dividend yield greater than 4%, we think that the trend over time will be for oil prices to go up, and we think that should support the price. And it also trades under 10 times earnings.
And why do you like Intel?
You know, Intel's not near as exciting a company as it was in the late '90s when technology was all the rage, but the price really reflects that, in that, you know, here again, is a company that trades right at 10 times earnings in technology land, which 10 years ago you wouldn't have expected to even see a dividend yield. And here's a company that also has a yield above 4%. And, you know, we like the prospects. As you saw with the earnings report yesterday, they're still growing their business. And we think this is a nice opportunity to earn a very significant dividend yield and take the next several years' worth of growth in earnings to move the price up.
Now, as a portfolio manager, are you looking more towards alternatives, currencies, options than you were towards equities?
We still think that equities play a very important part in client portfolios, and with valuations like they are today, we think that the prospects will be good over the next 10 years, much better than the last, obviously. But alternatives do play a part, and, you know, I mentioned earlier diversifying income sources is very important to us, also diversifying risk factors. And so the interesting thing that's happened in the marketplace is there are a variety of ETFs and open-ended funds that you can use to put in liquid alternatives that give you those different risk exposures, things like managed futures, things like long-short equity. And we think that does add a benefit from a diversification standpoint to the client's portfolio.
And just quickly, what's that breakdown for managed futures, long-short versus equities?
Our alternatives exposure is about 20% of the typical portfolio allocation in its entirety. So.
Okay, great. Thank you very much. Jeff Layman, BKD portfolio manager there. Thanks for making time.